Welcome back to another episode of Harmonious at Lunch, the show that fuels your business success. I'm Brandon Gano, your host and guide through the world of harmonious business growth. Today, we're unlocking powerful strategies with industry experts to help your business thrive. If you're a business owner, entrepreneur, or executive, you are in the right place. Join me and our incredible guests today on the journey to clarity, growth, and success. It is time to revolutionize your approach to business. Let's dive in with another episode of Harmonious at Lunch. Welcome back into some more bite-sized business advice. In today's episode, it's my favorite topic ever, but you got to hear the name to it. It is using taxation jujitsu to avoid paying more taxes in your business. I hate paying taxes. Most people I know feel the same way, and I'm sure you do too, but I have a very special guest with me today. We're going to break all this down and see what we can do about paying less taxes, even though it's the beginning of the year when this episode is going live. We are recording it at the end of the year. So I don't know if that changes anything, but anyway, Matthew Sercely, welcome to the show, and thank you for being here.
Thank you. Glad to be here.
So that was a little surprise that I just dropped on you that I probably should have told you before we started recording, but Happy New Year to everybody. It's the end of January, at least at the time this episode goes live. I know that doesn't help us a whole lot for last year's tax strategies, but going forward, at least this will help. But I love this topic, taxation jujitsu. Please tell me what you mean by that, because it's the most creative title I've ever heard.
So jujitsu is using an opponent's strength against them. It's designed that, somebody could be stronger than you, faster than you, tougher than you, and you use that against them. It's the same thing with taxation. The federal government has rules, and you can use those rules against them.
I like that. Are we going to get in trouble? Are you going to get me canceled for posting this podcast episode?
Not at all. This is 100% legal tax advice. It's avoiding taxes, which is totally legal, not evading taxes. In fact, I love it. There's a case from very early on in the insurance code that says that not only is it legal to do things to avoid taxes as long as you're following the rules, it is your patriotic duty as an American to pay as little as you can in taxes.
You know what? When you phrase it that way, now I even like it more. It's your patriotic duty to pay less taxes. I recently heard, or I saw a video clip, I think it was Reagan, who said, and you can fact check me on these numbers, he said the American people don't realize that roughly, no matter what tax bracket they're in, they lose 50% of their income to taxes every single year. Is that a relatively accurate number? And if it is, should we also be very shocked by that?
Yeah, that's pretty accurate. Once you throw in things like sales taxes, property taxes, state income taxes, there are, lots of taxes we're paying we don't even realize sometimes. I mean, there's taxes on your cell phone, there's taxes on your home phone if you have one, there's taxes on your internet. So I mean, it depends a little bit who you are, where you are. If you're in California or New York City, it's probably closer to 60%. But best case scenario, yeah, it's almost certainly at least 40% of your income is going to pay some tax somewhere.
Yeah, for a country that was founded on the principle of 2% tax on tea is too much. Oh, how far we've come in 250 years, Matthew. Anyway, I could talk about this all day long. But where do we start? Where do you usually start with business owners when you help them use taxation jujitsu to lower their tax burden and help keep more money in their pockets?
So actually, this episode is going to come out at a great time, because the very first thing you need to do is you need to get your business set up in the right format. And there's 4 major types of ways businesses are taxed. It can be taxed as a sole proprietor or a partnership, or taxed as an S corp, or taxed as a C corp. And generally, if you have an LLC, you can pick what you want every year, and you've got until March 15th to pick it for the rest of that year. So, if this is coming out in January, you've got about 45 days, 60 days to figure that out. And depending on where you are in your business and how much money you make, and are you reinvesting all the money in your business, or are you living off of it, there are different things that are better. For many businesses, I would say a majority of small businesses, setting up as an S corp is going to save you the most money, because you're going to avoid a lot of self-employment tax. which is basically an additional 15.3% income tax on addition to the normal income tax. But for some people, you may do better as what's called a C corp, particularly for very high net worth individuals. If you're making $1 million plus a year, oftentimes that is going to be a cheaper way of or an easier way to avoid as much taxation as possible. And there are even times being a sole proprietor or partnership is the right way to do it. I personally in my business operate as a sole proprietorship because for my business, I pay the smallest amount in taxes. So you just got to get that right, and you got to keep it right, because what works best for you now may not be the right thing in 2, 3, 4 years.
Yeah, that makes sense. Talk to me real quick about the whether it's the revenue range or the profit range for an S corp. You covered C corp. I had an accountant a number of years ago in my business tell me it was time to upgrade to an S corp. She said $100,000. I couldn't remember if it's revenue or net profit is kind of the sweet spot. Do you have any insight on that?
All of it's going to be based on your net profit, and honestly, $100,000 I think is too late. If you
Oh, okay.
Because the main cost is setting up an LLC. So if you already have an LLC, it makes more sense to do it. But realistically, at even $50,000 or $60,000 net profit, I mean, you could save $3,000-$4,000 a year in taxes. So
Okay.
to me, that's worth it at that point. It tends to stop working as well once you get to about, and this goes up every year because some of the tax ranges go up every year. But in 2024, at about $225,000 to $250,000, it stops working nearly as well. And by $300,000, it's probably not the optimal way of doing it. Although, due to very random circumstances, after about $1 million, it also can start working better.
Interesting. But in that range, or at least above the 300,000, that's where C corp would come in, if I'm understanding correctly.
It's where it should be considered. Some
Okay.
people are still going to do better as the S corp. It just, the big thing about the S corp is you're avoiding payroll taxes, and so once you've maxed out your Social Security payments, you don't pay much more in payroll taxes. But again, everybody is different. It depends is my favorite answer because I'm a lawyer. But it really does depend. There could be a business making $50,000 that would do better as a sole proprietor, another one that would do better as an S corp, and a third one that might do better as a C corp. Because C corps are also great for just, I've got a side business and every bit of money I'm making, I'm investing back into the business, and I'm not taking anything out of my pocket. C corps are absolutely great for that.
Interesting. I love and hate the answer. It depends, but I see where you're coming from. Don't get me wrong. So please consult your own legal team or accounting team on this, or reach out to Matthew. I'm sure we'll drop those links down below later. But okay, so we have our structure set up. There's still time to select a structure that's going to work for you. There's still time to consult on that. What should we do after that, or what are some other ways to use taxation jujitsu to our advantage?
So the next thing is going to be to look for what is money you're currently spending on after tax, money that you're making the money, you're putting it in your pocket, and then you're spending it, that you can instead spend from the business and then pay it before you pay the taxes. My absolute favorite way of doing this is paying your children. If you have children and they don't have a job, they get their own standard deduction. I don't know off the top of my head what that's going to be for 2025, but it's over $14,000 in 2024. So the first $14,000 you pay your kid, they pay no income tax. If you're in the 28% or the 32% or the 50% tax bracket between state and federal, that's saving you a huge amount of money. And you can then take that money you're paying your kid and spend it on stuff you would pay for them anyway. So if they're in sports or gymnastics or scouts or music, you can pay them and then take that money out of the bank account and pay for things for them. But now you're paying with basically pre-tax dollars instead of post-tax dollars. Now, they actually have to work in your company, and it's got to be a reasonable wage. You can't pay your 7-year-olds $200 an hour for anything. But a
Being
little bit can
cute.
go well, and even one of the standard things. Oh, my kid's 3; they can't work. Well, they can be a model for a photography shoot, and you can put the photos up on your webpage. And you can charge them $500 or $1,000. It's, you're not going to retire on that, but that's still money in your pocket instead of the IRS's. Travel is another great thing that can become a business expense as long as you follow the rules. So, for example, there's a reason that there are so many conferences in LA and Las Vegas and Miami and New York City, because people want to go to those places. But if there's a conference you can go to for your business, now it's a business expense to go there. And so your hotel, your food, your airfare, or your gas to get there can all be a business expense. And this is a pretty broad thing. Like you don't have to be going to something directly about your business. If you're a veterinarian, say, it doesn't have to be a veterinary seminar. It could be a seminar on advertising and marketing businesses in general. It could be about, using technology to improve your business in general. And so there's lots of things you can find. And again, 100% no questions asked as long as you follow the rules. This is legal. This is allowed. The IRS wants you to do this because they want you to go to these conferences. They want you to meet people. They want you to find new customers. They want you to learn how to do your business better so you make more money, and then they think they'll get a better cut. Now, when you do things right, they don't get a better cut, but they don't have to know that.
It's fully in effect as long as you're not going to a tax conference to learn how to pay less taxes.
Well, except I do that. There's a conference in the Cayman Islands of all places that does tax stuff, particularly for CPAs and attorneys. And I've been to that conference, and I did write off that trip basically 100% for myself. Couldn't write off my wife's part of it, but mine totally tax deductible.
I love it. Wait, I know this came about in COVID where meals used to not be 100% deductible, but then they were for a certain period of time. Did that ever go back, or is food still 100% tax deductible?
Yeah, sadly, in 2023, almost all meals went back to 50%. There's a few
Okay.
limited categories that are allowed. The two biggest ones that are 100% are a holiday party or other party for your employees. Most of my clients are small businesses and don't really do that sort of thing. But if you do a holiday party, that's 100% deductible instead of 50%. And food for customers is 100% deductible. So if you do an appreciation dinner for, and it's like it's got to be like just people in the office. So like you can't do a dinner for your clients, but if you have like snacks out in your office that customers or potential customers can grab, that's 100% deductible. A long story short, it's almost all 50%, but that's better than 0%.
It's better than 0% for sure. That makes sense. So, I mean, this stuff's really interesting, and I find that not a whole lot of people use it to their advantage because it's also work. You have to understand this, or you have to be working with an accountant who does understand it and wants to put in the work to save you money. But what are some of your favorite deductions that you found for your clients that most people would never even think that they're deductions?
Well, so we were talking about this just briefly before we got on, but every single business can make an argument that it needs security. And so, better locks for your home, better computer software to protect your files, that's pretty standard stuff. But if you're in any sort of a business where you may need to protect yourself, a firearm can be a valid business expense. Don't go crazy. Don't go buying the $5,000 super flashy thing, and don't do it every year if you don't have a good reason. But almost any business can do that. Now, some can get away with more. If you're a farmer and you have livestock, you need a firearm to protect those animals, and you can probably get away with a little more on that. So that's one of my favorite kind of, almost no one thinks about it, but it's there.
You kind of sound like
Examples.
my wife when you say, don't go buy the 5,000 thing because there's no good reason. I can give you a good reason. You just won't like it.
Well, and so this comes down to, for anything to be tax deductible, and people express it differently. The IRS says it's a two-part test, but it's really three parts. It has to be ordinary, necessary, and reasonable for your business. Thankfully, necessary just means it helps you make money or helps you get customers or helps protect what you have. Ordinary is this is the type of thing people in your business buy. So, for example, if you are a farmer, the types of things farmers buy is normal for you. But, a Maserati probably isn't.
That's a new kind of farming. The
If you're a
IRS doesn't know about that
lawyer,
kind of farm yet.
if you're a high-priced lawyer, maybe that is an appropriate thing to buy. And then similarly, it's reasonable. And for reasonableness, it's basically how expensive is it and does it make sense financially for your business? So this is where we get to, again, maybe a lawyer could say, oh, it's ordinary for attorneys to buy this sort of a car. Well, but if you only make $100,000 a year in your business, then that's not reasonable. That's too expensive, probably. And so that's the area where on these things that are a little bit more out there, the IRS will go after you if they want to challenge it. And so again, buying, a $700 Glock, I think they're $700. I haven't priced one in a while myself. Or even maybe $1,000 AR-15, probably going to be fine. But, don't go get the gold, plated, fancy whatever, unless you can justify it. Again, that farmer who's got, 1,000 acres of land can probably justify buying a really good scope for a rifle that maybe you couldn't to defend your home. What is reasonable does depend on the business. If you're making $1 million a year, it's a little easier to get away with what's reasonable than if you're making $20,000 a year.
I'm curious about the reasonable part too, because it seems like that's also a protection mechanism that maybe skirts the line of tax evasion. So for example, if I'm trying to hide some funds and I hire you and your normal invoice is, let's say, $20,000, and I'm saying, hey, Matthew, I really need to hide 50,000. Can you inflate your invoice for me? Is that sort of what that rule is getting at? Because I could see where that would be relevant and important.
I don't think so. Again, I really think it's more designed to make sure that the thing is really being purchased for a business purpose.
Okay.
They're trying to make sure that, again, this makes sense for your business. The common example I actually use, I've got a friend who is a strength coach, and he drives around here in Dallas to people's homes with some of his stuff in his vehicle. Well, he can't use a Mini Cooper for this because it's not big enough, and he's got expensive stuff in the back of his vehicle, so a pickup truck doesn't work. So he's got a full size SUV, which is totally reasonable, but the Tesla van is so expensive it'd be hard to justify. Why is that a reasonable expense when you could have just bought a minivan, a regular minivan, right?
Mm.
Now, if he were the strength trainer to the stars in, Los Angeles, working with people in Hollywood, now maybe that's reasonable, because are those stars going to work with the guy driving, the Honda Odyssey, or is the fact he can afford and has the high priced Tesla maybe going to get him the business? And so again, there's a lot that looks into this. There's usually not a yes or no. It's oftentimes, what does it seem like? And the final test, whether the IRS admits it or not, is a lot of times, did you actually make money and pay taxes, or did this cause your business to lose money? If you are spending so much that on paper your business is losing money, IRS doesn't like that. They want to see that you're profitable, or they're going to say, maybe you're not a business at all. Maybe you're a hobby. And you don't get any of these deductions anymore.
Yeah, no, it makes sense. And I love how Matthew's throwing some shade at Honda Odysseys here. We are not sponsored by Honda on this show, so it's totally okay. Matthew, no, this is great. And these are things that every single business owner needs to explore. It's the beginning of the year. It's the time to do that. You could talk about your structure and then get into, of course, deductions throughout the course of the year. Now's the best time to do it because you can keep a good record for the rest of the year. You don't have to go back like some people do. They try to cram it all in December, or worse, April 14th for the last year, and hope they get it right and don't miss anything. So Matthew, this is great. Perfect timing. Where can the listeners go learn more about you and all the advice you have around taxation jujitsu?
So the best place is going to be, I've got a link on my website where you can download a report with over 60 of those ideas for what you can deduct, things like the firearm. It's agoristtaxadvice.com/harmonious. Agorist is a weird word. It's AGORIST. taxadvice.com/harmonious. Free download, and you'll also get a link in a couple of days to set up a free phone call with me if you just want to see if we're a good fit.
I love it. Matthew, thank you so much for being here.
Thank you.
Wherever you're watching or listening, that link is down below in the show notes. If you are watching, it's also on the screen. And if you can't spell harmonious, I mean, please unsubscribe. No, I'm just kidding. We want you to subscribe. Please, whatever platform you're on, subscribe, come back. We want to keep giving you daily business advice to help you grow your business. More importantly, build a more harmonious business and life. We'll see you tomorrow on Harmonious at Lunch. Thanks for being here.